All right. Hello, everyone, and welcome back to Tech in Asia's Product Development Conference 2022. I hope you guys had a good little break, maybe got a little bit of caffeine in your veins and are ready to face the second half of day one. Just a reminder to find out more about the full agenda, the speaker lineup, and all that, and also to connect with other participants, you can visit the schedule and booth tab within the platform itself. And also, I just want to take this chance to say thank you to all our sponsors, without which, of course, this conference would not have been possible. Do check out their booths. Maybe they have something that you never thought you needed, right? Okay, so let's proceed with the second half of day one. For this first session of the second half, we will be hearing from Valerie Wagner, Head of Product for APAC at Stripe, and she'll be talking about driving fintech product growth. Now, there will be a Q&A session after her presentation. So as soon as you think of anything, just drop them into the chat box and we will get to them at the end of her presentation. All right. All right, Valerie, are you ready? Are you there?
Hello, hello.
Hello, hello. All right, very good to have you with us. And if you're ready, the stage is yours.
Fantastic. All right. I am so excited to be here with everyone. And very excited to be talking about driving fintech product growth. Just as a quick background, I'm heading product for APAC at Stripe. I'm super energized by being part of Stripe right now and growing our mission. I love the mission of Stripe of helping other businesses grow by doing all the hard nitty gritty things when it comes to payments and money movement and financial services, so that our customers who are tech companies and startups and other businesses like you can grow by focusing on the problems you uniquely solve for your customers. But I'm not here to talk about Stripe today, but more to talk about some frameworks that I've learned from about how to drive product growth, in particular fintech product growth. A big parts of my career have been focused on fintech products. I originally moved to India back in 2007 to work on a payments company. Then founded a company in India, grew that until it was acquired by Twitter. Wanted to get back into fintech, and so was heading international at Credit Karma, based in San Francisco, and then came back over here to this region, based in Singapore, to lead as Chief Growth Officer of GoPay within GoTo, and now at Stripe. In my spare time, something I absolutely love doing is being an executive in residence at Reforge, which is really focused on content and community for companies and professionals to hone skills in growth and product and marketing, engineering, etc. So I'm kind of have a bunch of fintech experience and care a lot about product and growth as sort of specialties, and I'm super excited to share some of my lessons with you today. So what we're going to talk about is not a bunch of tactics or sort of shortcuts to growth, but more frameworks and tools by which you can think about your own products and apply this thinking to your own products and your own users. We're going to work backwards on defining and measuring your growth, starting with retention and then activation and acquisition. So let's dive in. Retention is really the most important driver of how your product grows, including fintech products. And why that is because retention is what really compounds your growth. Linear tactics are you have to keep being repeated and repeated and repeated and don't scale. But if you think about your growth as kind of retention loops, that's really the power engine of what's going to drive your product. As you retain more users, you're going to be able to increase the way that you monetize those users and the virality you can create from those users. And that will help you attract larger future cohorts of new users to then keep the cycle going. So what we'll talk about in a bit is an approach to defining your retention metrics. But let's just anchor first on kind of thinking about standard retention curves. You want to, whatever your retention metric is, that we'll walk through some examples in a second, you have new user cohorts who are signing up, and over time, a percentage of them are still retaining and still doing those core actions in your product that demonstrate that they're getting value out of your product. Now, if you're in a state where your metrics are the bad line on the bottom there, where they don't really flatten out and they keep sloping down, 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 you do not yet have a compounding growth engine, and you do not yet have kind of compounding retention in your product. So you want to aim for a curve that flattens out somewhere. And ideally, even a curve that over time grows into a smile and slopes up again, because as your product gets better and better, your older cohorts start resurrecting and coming back more often than they had. So that's kind of how to visualize the output, but let's think about the inputs, about how to define your retention metric. And it really starts with understanding your use case. So we got to first define your use case, which is identifying and literally documenting what is the problem that you're solving for your users. What's the definition of their problem in their words that they're trying to solve? Who is it that has this problem, as being as specific as possible about that? Why is it that they choose your product to solve that problem? And what are their alternatives that they could choose? And then also importantly, how frequently do they encounter that problem? So if you think about this and literally write it all down, and your product might have multiple use cases, so if you kind of define one for each use case in a kind of map, you're going to use that as a basis to then create a hypothesis around your retention metric. So the frequency is the source of the frequency with which your users have that problem is the source of the frequency part of your retention metric. And you're going to use the problem that users are having and why they choose your product as the basis for defining the core action that users are taking that we're going to use in our retention metric. So ultimately, we need to define the frequency, the core behavior, that's the action that demonstrates that the user is solving the problem with your product, and really defining who that user is. So in these couple examples, these are a couple fintech products that I've worked on personally. One is Credit Karma, mostly a US product, also in Canada and the UK. And the problem that the user has is that they need access to understand their credit health, their credit bureau score, how it's moving over time, and how that impacts their costs of credit in their life. This is a monthly kind of problem that users experience, and the action that demonstrates that we're solving the problem for them is when they log in and check their credit health. The metric is based on the user in this case, so it applies to all users who have a Credit Karma account. Another example, GoPay as a wallet and as a payment mechanism is a weekly kind of problem. Users need a convenient way to pay where cash creates a lot of friction because maybe it's an online payment or a delivery, or they just need an easier way to send money to a friend. And so weekly is the higher frequency with which users face this problem. The indication that we're solving the problem in GoPay's case is that they're actually making a payment with GoPay. It's not that they're logging into the app, it's not that they're checking their balance, but it's actually that they're making a payment. And the user in this case is a top-up user, so a user who actually has balance in their wallet. Now, if a user does not have balance or has low balance, that's a different kind of activation problem we're trying to solve. So we're really trying to measure like what's the frequency with which top-up users are making payments, and we're solving that problem. So those are a couple examples, and you can think through that framework above for your product and your use case. So once we have this hypothesis about on a qualitative level about a retention metric, we need to create frequency histograms about actual usage in our product and analyze that distribution to validate this hypothesis. So for example, if in the Credit Karma case, we had a hypothesis that it's about monthly that users experience this problem, we want to see that the core behavior of logging in and checking credit health is happening on roughly a monthly basis, or like 1 or maybe 2 times a month. And that validates that, in fact, it is a kind of monthly problem that we're solving. Or maybe in the GoPay case, because we believe it's a weekly problem and we see in the data, yep, indeed, most users are using the product on a weekly basis. Now, sometimes your data might not validate. Like, let's say our hypothesis was that GoPay should be a daily use case, but we're seeing weekly data. Then we need to go back and question, like, are we solving the problem enough on a daily basis? Or is there, or have we actually misunderstood the problem that we're solving and it's actually more of a weekly use case? So you kind of go back and forth between the qualitative and quantitative understanding in order to really drive the definition of that retention metric. So here again are the first ones we mentioned for each of these products, but then you might have multiple use cases for your products. So in Credit Karma, in addition to monthly credit health checks, you might, on a yearly basis, apply for new financial products as your credit health changes over time. Or in GoPay, you might be paying weekly out of your wallet balance, but on a monthly basis, you might have an occasion where you've run out of cash at the end of the month, you haven't gotten your salary yet, and you want to have the convenience of using a GoPay Later credit to pay. In that case, the user is defined as eligible users who are credit scored. So we've talked about retention and how that's the powerhouse for your overall growth and how to think about approaching defining your retention metric. The inputs to actual retention that you're driving your product are based on activation, engagement, and resurrection. So we're going to continue working backwards and talk activation. And activation is really when the user has established the habit of getting the value prop out of your product. How improving activation is going to impact your metrics is that it's going to shift up your retention curve. So newer cohorts are going to be more likely to retain, and that retention curve is going to flatten out earlier than older cohorts. So again, first priority is making sure you've got retention and that you get to a flat point with that curve. The second priority is then activation, where you're shifting up how well your new cohorts are performing. So in order to define and really understand activation on your product, we need to work backwards again from engaged users where the habit is established and they've continued to use the product over some defined period of time. Walking backwards is the habit moment when they've now found that moment where they've achieved the value prop and you've done the core action and gotten the value out of the product enough times that we've established a habit. There are ways to accelerate this creation of habit. So here's a kind of overview of four main types of ways, but we're going to go specifically into an example of manufactured loops as a way to trigger and drive habit formation faster. So with manufactured loops, there's some kind of cue or trigger that happens in the product or related to the product. And through some channel, typically email or push notification, the trigger is delivered to the user. The user then has the opportunity to take an action, take that core action around which you're trying to establish the habit. And then they get a reward for having taken that action. And that's more likely to then get them to, trigger another impact in the product and keep it going. So in the Credit Karma case, a score change or other credit bureau alert, like some change in someone's credit profile, is the trigger that happens. That indicates an email or push notification to the user to say, hey, your credit score has changed. Why don't you come in and check it out? The user logs in, checks their credit score, and they're rewarded by having better information and being empowered by a better sense of understanding how their credit score is moving, and also getting access to new financial products that are more appropriate for them as their credit profile changes over time. So as the user continues to engage, they are more likely to be more aware of their credit profile, take actions to improve it, maybe apply for a financial product, and all of those things are going to then in turn impact their credit score changes or other alerts, which then will trigger more queues and then keep the cycle going and keep users coming back. So continuing to work backwards, we talked about starting with what does an engaged user look like, finding ways to accelerate that habit moment. And then, the aha moment is the first time that a user experiences that value prop before they're able to do it multiple times and establish the habit. But in order to get to that aha moment, you have to have the right setup moment. So the setup is the experience that users go through to set up a set of actions so that they're ready to enjoy the value prop that your product brings. This is particularly important for fintech products because in general, for any product, a cold start can really kill momentum in establishing that habit. So imagine logging into a product for the first time and it's very blank and you don't know what to do and there's no templates or cues or indications of how to use it or how to get value out of it. It creates a ton of friction and you're unlikely to go through the pain of navigating around and trying to figure out how to use that product. So a warm start is really important. For example, with GoPay, there's the experiencing remember in that case, the core action is making a payment. And that's the real kind of aha moment and value prop when someone experiences the ease of making a digital payment rather than a cash payment. Now, actually topping up and getting balance into your wallet for the first time is a lot of friction. So if you create a GoPay account that has zero balance in it, and then you have to figure out how to go top up with cash at an Alphamart convenience store or link to your bank account and top up from your bank account, there's a ton of pain. So that's like a cold start experience. So we tried to do things like warm start experiences, like when someone was using Gojek but for ride hailing or delivery, instead of giving discounts on prices, it would give cashbacks in the form of GoPay balance. Now, a new user who hasn't used GoPay before has some balance to start with. And that's like a warm start experience that can get them experiencing the value prop for the first time and taking that core action for the first time, and then encouraging them to come back again. Another type of fintech product examples are like robo-advisors like Stashaway or Endowus. Imagine, how hard it would be for a brand new user to start, doing investing through a robo-advisor without like a really kind of curated and handheld and warm experience that's as personalized as possible to them with as many kind of tips to get started as possible. So this is a, really defining that setup moment is really important for activation and ultimately retention, especially for fintech products. So when you have all these defined for your product, literally write it down, right? Like for your use case, write down, and as part of your use case map, all of those habit moments, aha moments, and setup moments as well. So you can make sure you're measuring and building your product experience around those. So we talked about retention, talked about activation. Now we're going to talk about acquisition. Acquisition is not about funnels, where funnels is a mentality around having a very linear kind of approach to repeating a bunch of linear tactics that have some level of dropout rate, some level of conversion, but they don't compound on each other. So it's really important to think about acquisition as loops. I could spend days talking about this, but we're going to breeze through a couple examples. In terms of acquisition loops, there's 4 main types: viral, content, paid, and sales. We're going to give you an example of paid loops with Credit Karma again. So paid loops this is how paid loops were a really important part of Credit Karma's growth. So I'll explain how that worked. A new user signs up because they've acted on an ad and they activate their credit history and they're using the product. Now, some of those users convert, apply for financial products, and ultimately Credit Karma monetizes them. So it's a free product for users to use initially. When a user happens to, say, apply for a credit card or a loan or a refinancing on their car loan in the Credit Karma product, then Credit Karma monetizes that with the actual partner who is providing that credit card or loan. And so some small percentage of total users in any given month or any given week are applying for financial products and are monetized. That monetization allows Credit Karma to then buy more ads to send out into the world and attract more people who view the ads and click on them and become new users, thereby, cycling the loop. So what's most important, if your product is using paid loops, you need to think about all of these steps and how each of these steps might be optimized, and really think about quantifying your growth model and how this loop is working for you, and making sure you're optimizing at different points. The primary constraint on paid loops is the capital you have to reinvest in the loops. So payback period is the most important thing, right? It's not just about lifetime value of a user, because lifetime value can kind of manifest over time, but the payback period, with how fast you're able to turn that money back into the loop and keep powering the loop, is the most important thing. Also touch on viral loops, which is typically less common with financial products, or assumed to be, because finance is a pretty personal thing. But again, extending the Credit Karma example, 40% of new users who signed up for Credit Karma signed up because of word of mouth, which is one of the types of viral loops. I also worked on, when I was there, a hypothesis on how do we introduce more organic loops, meaning where one user invites another user to the product because of some natural use case that's not incentivized, but that is where, because they're both invited to the product, it is the product experience gets better. So what we experimented with was a household product. So the hypothesis was that when you're making big decisions about your financial situation, whether or not you're going to apply for a credit card or take out a loan or refinance your mortgage, you're probably going to be discussing that with maybe your spouse or your partner or your older parents or something like that. And so by having family members using the Credit Karma app as the center of that conversation, we're more likely to capture a greater share of those types of transactions. They're using it, or more likely to add more value to those conversations. So that was kind of the underlying use case hypothesis that we had. And we attempted to build those viral loops into the product, where a new user signed up, a percentage of those who signed up created a household and created a kind of group on the Credit Karma app. A percentage of those sent invites to their household members, and then a percentage of those converted and actually joined Credit Karma themselves as new users, and therefore continuing the loop. The primary constraint for viral loops is a function of how many people each user will invite to your product and how many of those invites will convert. So in, say, a Facebook case, the value of the product grows the more friends you have, at least up until some point. In the Credit Karma case, we knew intentionally that was going to be relatively limited scale virality, because there's a limited number of people in your household, especially those with whom you're going to make financial decisions and manage your credit. But we still wanted to use that as a lever for not only new user acquisition, but also ultimately driving retention. So viral loops are often not central to fintech products, but there can be creative ways that you think about how that might be powerful for use cases you're solving for your users. So again, just a super quick recap of what we talked about today. This is really about thinking about the frameworks and tools that you can use to define and measure your own growth for your products by working backwards. We started talking about retention and how retention is really the core and the power plant of how you drive growth. How activation and really defining those habit moments, setup moments, et cetera, are important to make sure that you're optimizing your activation so that it can lift up your retention curves over time. And acquisition, not thinking about it as funnels, but thinking about it as loops. And we talked about a couple of those different types of acquisition loops that can help compound and spin your growth flywheel. I'm so excited now to answer any questions that you all have.
I think that was very interesting. Really, really getting people to understand how to drive fintech product growth. We do have a couple of questions for you from the floor. I guess first up, what kind of criteria do you look for when hiring new talent that can help to drive growth? Is it mandatory to have fintech experience beforehand?
I think any team needs to be the right composition of the team. So, in particular for fintech products, you need people who actually understand financial services and banking in the ecosystem. You also need people who are just excellent product people or excellent growth people, and being really intentional about the right mix and who's in what roles and what capabilities you need in what roles. So, if you yourself are a leader who's looking to hire, reflect on your own strengths and make sure that you're complementing yourself with people who are the yin to your yang and who are not exactly like you. And so much of fintech is evolving all the time. Particularly if you think about crypto and things like that, right? All the things that are yet to be experienced in crypto are just barely starting now, right? So anyone who has deep experience in that is not a tiny percentage of possible humans who are capable, and also B, like a lot of us on the cutting edge of fintech are trying to figure out new things all the time. So you do need to be thoughtful about where experience is necessary, but it's probably more important as well to have a growth mindset and be extremely curious and a creative problem solver and very empathetic about learning the industry.
Okay. I guess on that note, I just have a personal follow-up question. Like, do you have any examples of hiring someone different from yourself, and how did you like get yourself to trust in them? Because hiring outside of what you're familiar with can be a little bit daunting sometimes.
Well, I've personally hired many people who are different from myself. This also happened a lot when I moved to India, and then a couple years later started a company in India. And like, guess what? As like a white American lady, like a lot of people I hired were very different from me. But I mean, not just from that level, but also, I'm a product person mostly by kind of background, but I also am very much a generalist and a kind of GM or startup CEO type mindset person, more of a jack of all trades, master of none. And so I am very eager to hire other masters in areas that I am not great at, to kind of round out the whole team.
Okay, all right. So okay, this is slightly related to the whole hiring and training content that we're talking about right now. Question that we're talking about right now. Edwin Yong is asking, right? How does he, as a tech consultant, break into the product space? Like, do you have experience with dealing with applicants that are actually from a different background entirely?
Yes. So all product there's product managers need to have a kind of baseline skill sets, but they're depending on the product, depending on the role, depending on the scope, you need different kinds of spikes, right? If you're going to be a a growth PM, you need to have a very analytical mindset. You need to be pretty numeric and good about like structuring experimentation and things like that. And if you are going to, but if you're versus doing like core, 0 to 1 type product growth where you're doing product market fit expansion, for example, like doing Credit Karma International is like expanding into new markets. You need to be much more like think about the market strategy and the partnerships and like how all the pieces fit together. And so, but maybe less on say the technical side than if you're like designing APIs at Stripe, right? So I would think about like what are the broad capabilities, and I have a specific like article in mind that I really like that helps kind of, I don't know if there's a good way to like share this to the group chat or something in this forum, but the PMs need kind of some core common capabilities, but every PM is going to spike in different ways, different roles. So you need to think about what your spikes are in that spectrum and which type of PM roles are the ones where you're going to shine the most, and try to break in through those type of roles and then get some experience and then gradually expand your portfolio of skills and your best spikes.
Okay, so focus on your strengths first before working on your weaknesses, basically.
Yeah.
Yep. Okay.
And find role fit for your strengths.
Role fit.
Especially when you're trying to shift into like a new type of job like product.
All right. Okay. Next we have Camille, who is asking. I think she wants to know a little bit about your personal journey. Can you share some challenges that you faced or initiatives that you took that did not work out, and what happened?
Oh my God, how many days do we have?
The top 3. Let's go with top 3.
Yeah, but I sent to the host the article I was thinking about that helps break down the job specializations. I don't know if there's a way to like broadcast that back to the audience, but some of the challenges I faced. I think most important is to. I mean, you're going to face challenges all the time. The key is you want to have early stage blowups and not late stage blowups, right? If you're going to face a challenge or have a failure, you want to have that failure early at lower cost and lower time spent for other well-intentioned humans. Even for example, the example I gave of like experimenting with viral growth loops at Credit Karma. That's an example of something that was some things are obvious failures, like you experiment and it fails and you move on quickly. Some things are obvious successes that you can double down on quickly. The hardest part is everything in the middle, and the challenge is when something goes like okay but not great. The experimenting with like the household product within Credit Karma and introducing those viral growth loops and that social use case that I mentioned in the talk. That was one example of those that was like, went okay, not great. And then it's harder to make decisions about the ROI of investing further in that versus focusing on something else. So just making sure that you're not spreading yourself, like, be careful of that middle zone when something's either not a total obvious failure or a total obvious success. And make sure that you have few enough bets you're making that you're really putting enough into them. If you spread yourself too thin, you're going to not set each of those bets up for success. And you may not be and you might either throw them out too early because you haven't put enough in to really try to make it work, or you may set it up for failure because you're not really fully committing to it. So just be very conscious of usually all of us need to make a smaller number of bets and being very thoughtful in that middle zone about what you're killing and what you're doubling down on.
All right. Okay. Next question. You did mention earlier that you're a little bit more of a generalist. This relates to that. Yearling is asking, would you consider product management more of a generalist or a specialist role? And which do you think is a little bit more valued?
I think it's more, in my mind, more generalist. There are
Mm,
specialist product managers. There are ways in which people can really specialize within product management, but you have to understand enough about all functions, because the success of a product manager is ultimately like designing a product that users love and growing that product. You can only grow that product not just by having product market fit with the user's needs, but you
mm,
have to have fit across product, market, channel, and pricing.
mm. Right.
Channel meaning, how are you getting it to users? How are they even discovering it? And pricing meaning, like, how are you going to monetize this thing? Like, how are they paying for it? Who's paying for it? Right. And you might have build a bunch of great features that add value to a market, but they're not willing to pay for it, or they never learn about it because you haven't gotten to go to grow through the right channels or get exposure through the right channels. So you necessarily have to be a generalist that understands enough about your marketing levers, about your business strategy, your commercial strategy, your pricing, about your users, about the technology and how you're building, so that you can get fit across all these four dimensions.
Mm. Okay. All right. All right. Next question is from Risky. They're asking, how long does a typical growth flow identification take? Taking into consideration from coming up with the hypothesis all the way to validating and having the flow identified.
Mm. Uh, the I mean, it shouldn't take years, but it also doesn't just take days, right? So, I mean, I would say, if the most important thing is to commit to defining these things and carving out the space, right? And if you really ask yourself the hard questions, like, how does my product grow? Do you have an answer to that? Do you have like a really core answer to that connects the dots on like all the things that need to happen for your product to grow? If not, then like, okay, let's start building that, starting with, what is the right retention metric? Like, how do you define it today? Is that a true reflection? Is that truly defining growth? If you don't have that, then like carve out the space to do it. Like, it's not the type of thing you can spend 1 hour a week on. If you spend 1 hour a week on it, it's probably never going to get defined, and it's going to take you months. But if you really carve out the space to say, like, okay, I'm going to tackle this for the next, let's say 1 week, to really define the use cases, validate that with other people on the team, and then another week to really dig into the data and map that against it and validate some hypotheses. And then, like, a third week to kind of lock that in with the decisions in with stakeholders, and and start to align that to OKRs and the strategies people are using, and then set up dashboards, and over the next few weeks make sure we're like tracking that metric in the right way and surfacing it in the right dashboards and forums to know that we're performing against it. So you can kind of imagine like an exercise of like a few weeks or a month or 2 months to make sure you're then measuring it and it's then validated and it's starting to take hold in the organization. That depends a lot on how well things are defined, how big your team is, how complex your product is, right? But that's a quick illustration.
Okay. All right. Unfortunately, I think that's all the time we have for the questions. There are actually quite a few more. Sorry, couldn't get to them. There's not much time left. Please, of course, feel free to reach out to Valerie. I'm pretty sure she'll be quite happy to answer you outside of this session.
Yeah,
Valerie, thank you so much for sharing everything that you have shared and answering all those questions.
yeah. I'm just Val Wagoner, VALWAGONER, on Twitter, LinkedIn, whatever. Feel free to ping me anytime, and I'll answer as best I can.
All right, there you go. There's no excuse for you not to have your question answered now, right? Okay. Thank you so much, Valerie.
Thanks. Bye, everyone.
All right. So, to the people at home, yes, that was the first session of the second half. Next, we will be getting there'll be a keynote presentation from Yash Tucker, Associate Director of Sales at Sears Incorporated, and he'll be talking about site reliability engineering for cloud native products, right? I don't think you want to miss that one. And so we'll be right back very soonly.